To grasp why this matters, one must first understand how modern markets function. Prices in futures markets are influenced not only by physical supply, but by expectations and speed. Traders react to what they see on screens, often within seconds. Algorithms react even faster. In such an environment, perception can move markets before reality has time to respond. The strategy described in official findings relied on this gap. Large orders were placed into the market without the intention of execution. These orders created the appearance of overwhelming supply or demand. Other participants reacted logically to what they believed was real information. Prices shifted. Only then were the original orders removed, leaving the initiator positioned to benefit. This practice is known as spoofing. It is illegal. Yet it is difficult to detect in real time because it operates at machine speed. By the time a pattern becomes visible, the opportunity has already passed and the profit has already been taken. Over many years, this activity generated significant revenue. During the same period, the institution involved expanded its role within the precious metals ecosystem. Its influence deepened, its responsibilities increased, its position became more central. When enforcement finally arrived, the penalty appeared large in public discussion. The number itself drew attention. But in institutional finance, numbers are never judged alone. They are judged in relation to the gains they offset. If profits earned over time exceed the eventual penalty, the behavior that produced them is not discouraged. It is validated. This is where the illusion of fairness begins to break down. The market continued to function. The institution continued to operate. Leadership remained in place. For observers outside the system, accountability appeared complete. For those inside, the lesson was more subtle. For entrepreneurs and business professionals, the implications are serious. If the largest participants operate under a different risk framework, smaller participants are exposed to signals they cannot control. Prices may reflect power and speed as much as supply and demand. This is not an argument about morality. It is an observation about structure. Systems reward behavior based on incentives, not intentions. When enforcement arrives late and consequences are absorbed broadly, the system teaches the wrong lesson. Understanding this reality is not optional for serious decision makers. It is the starting point for managing risk in markets where appearances can be engineered and consequences can be delayed. To grasp why this matters, one must first understand how modern markets function. Prices in futures markets are influenced not only by physical supply, but by expectations and speed. Traders react to what they see on screens, often within seconds. Algorithms react even faster. In such an environment, perception can move markets before reality has time to respond. The strategy described in official findings relied on this gap. Large orders were placed into the market without the intention of execution. These orders created the appearance of overwhelming supply or demand. Other participants reacted logically to what they believed was real information. Prices shifted. Only then were the original orders removed, leaving the initiator positioned to benefit. This practice is known as spoofing. It is illegal. Yet it is difficult to detect in real time because it operates at machine speed. By the time a pattern becomes visible, the opportunity has already passed and the profit has already been taken. Over many years, this activity generated significant revenue. During the same period, the institution involved expanded its role within the precious metals ecosystem. Its influence deepened, its responsibilities increased, its position became more central. When enforcement finally arrived, the penalty appeared large in public discussion. The number itself drew attention. But in institutional finance, numbers are never judged alone. They are judged in relation to the gains they offset. If profits earned over time exceed the eventual penalty, the behavior that produced them is not discouraged. It is validated. This is where the illusion of fairness begins to break down. The market continued to function. The institution continued to operate. Leadership remained in place. For observers outside the system, accountability appeared complete. For those inside, the lesson was more subtle. For entrepreneurs and business professionals, the implications are serious. If the largest participants operate under a different risk framework, smaller participants are exposed to signals they cannot control. Prices may reflect power and speed as much as supply and demand. This is not an argument about morality. It is an observation about structure. Systems reward behavior based on incentives, not intentions. When enforcement arrives late and consequences are absorbed broadly, the system teaches the wrong lesson. Understanding this reality is not optional for serious decision makers. It is the starting point for managing risk in markets where appearances can be engineered and consequences can be delayed. By the time regulators confirmed misconduct, the mechanism behind it had already done its work. What mattered now was not outrage, but understanding. Because the true risk to markets does not come from isolated violations. It comes from repeatable systems that quietly reward behavior long before anyone intervenes. At the center of this system was speed. Modern financial markets do not move at human pace. Decisions are made in microseconds, orders are placed, modified, and canceled faster than a person can blink. In this environment, advantage belongs to those who can act first and disappear before questions are asked. The institution examined in this case did not rely on guesswork. It relied on structure. Sophisticated algorithms were designed to interact with the market's order book, the digital ledger that shows buyers on one side and sellers on the other. To most participants, this book represents truth. It signals where supply exists and where demand may emerge. But the order book only shows intent, not commitment. Large sell orders were placed high above the current price. They were visible to everyone. Traders watching their screens saw what looked like overwhelming supply. The natural reaction followed. Buyers hesitated. Some canceled their bids. Others rushed to sell before prices fell further. The market responded exactly as expected. Then the orders vanished. They were never meant to be filled. They existed only long enough to shape perception. Once the price dropped, the same system that had scared the market stepped in quietly to buy at lower levels. Real trades followed fake signals. Profit was extracted from reaction, not value. This was not a one-time event. According to official findings, it happened tens of thousands of times across several metals in multiple years. The repetition matters. Accidents happen once, strategies repeat. What made this approach especially powerful was its asymmetry. The risk was limited. If the order accidentally executed, it could be canceled or offset. If regulators noticed, consequences would arrive years later. But profits were immediate. This time gap between action and enforcement created a structural advantage that compounded over time. The market itself became a tool. Other banks, hedge funds, and retail traders were not losing because they were unskilled. They were reacting rationally to false signals. They trusted the system to reflect genuine intent. The trust became the vulnerability. Eventually, enforcement arrived. The findings were announced by the United States Department of Justice. The language was direct. The activity was labeled fraud. The scale was acknowledged. A penalty was imposed. But enforcement did not address the incentive problem. From a business perspective, the most important detail was not the size of the fine. It was who paid it. The penalty was absorbed by the institution, not by the individuals who benefited during the profitable years. Costs were distributed across shareholders. The system remained intact. For executives and strategists, this outcome sends a clear signal. When penalties are delayed and socialized, they lose their power to change behavior. They become predictable. Predictability turns risk into calculation. Calculation turns wrongdoing into strategy. This is not limited to finance. Any industry where complexity outpaces oversight faces similar dynamics. When systems become too fast, too technical, or too opaque, enforcement struggles to keep pace. Those closest to the system learn where the blind spots are. For young entrepreneurs and business leaders, this creates a distorted competitive field. Ethical operators follow rules that others quietly bypass. Long-term builders compete against short-term extractors. Trust erodes, not because markets fail, but because they succeed for the wrong reasons. The danger lies in normalization. Once these practices are treated as historical events rather than structural warnings, they fade into background noise. The lesson is lost. The system resets without reform. This part of the story is not about condemnation. It is about mechanics. Understanding how advantage is engineered allows decision makers to recognize similar patterns elsewhere. The names may change, the assets may differ, but the logic remains consistent. In the next part, attention will turn to accountability, not legal accountability alone, but economic accountability. Because the most important question is not whether wrongdoing occurred. It is whether the system learned anything from it. After the investigation became public, many observers assumed the system had corrected itself. A large fine was announced. Official statements were issued. The case appeared closed. For the public, this looked like accountability. For professionals inside the business world, the outcome required a deeper reading. In complex organizations, consequences are measured differently. The central question is never emotional. It is structural. Who bears the cost and who keeps the reward? In this case, the penalty was paid by the institution, not by the individuals who designed or benefited from the strategy. Shareholders absorbed the loss. Annual reports recorded it as a legal expense. Daily operations continued without interruption. The people who made decisions during the profitable years did not personally repay the gains. This distinction matters. In any business system, behavior changes only when incentives change. If success brings personal reward but failure brings shared cost, risk-taking increases. Over time, this creates a quiet distortion. Actions that appear reckless from the outside become rational from the inside. For years, profits from the trading strategies flowed quickly and consistently. Bonuses were paid, performance metrics were met, careers advanced. The risk of future enforcement was distant and uncertain. When it finally arrived, it was negotiated, not imposed suddenly. This delay weakens deterrence. Effective accountability depends on timing. Immediate consequences influence behavior. Delayed consequences are discounted. In fast-moving industries, a 5-year delay might as well be a generation. By the time penalties appear, teams have changed, Leadership has shifted and memories have faded. The system moves on. From an economic perspective, the penalty functioned less like punishment and more like a fee. It closed the past without reshaping the future. The core structure remained untouched. Technology stayed in place. Market roles were preserved. Relationships with regulators continued. This outcome sends a signal, whether intended or not. It tells large institutions that scale offers protection. That complexity creates distance. That resolution is possible without disruption. Smaller participants do not receive this message. They experience enforcement differently. For them, penalties are immediate and often final. This creates a two-speed system. For aspiring entrepreneurs and business leaders, the lesson is uncomfortable but necessary. Markets do not reward fairness automatically. They reward positioning. Those closest to enforcement boundaries understand where flexibility exists. Those farther away operate under stricter interpretation. Understanding this does not mean adopting unethical behavior. It means recognizing risk accurately. Strategy based on false assumptions is fragile. Strategy based on reality is resilient. One of the most overlooked aspects of this case is what did not happen. There was no forced restructuring, no trading ban, no permanent loss of privilege. The institution maintained its role within the same markets where violations occurred. From a system design perspective, this is critical. If behavior leads to profit and consequences do not remove capacity to repeat it, learning does not occur. The system records the event as survivable. This does not imply ongoing misconduct. It implies unresolved incentive alignment. In well-designed systems, failure leads to constraint. In poorly aligned systems, failure leads to adaptation without reform. Processes change quietly, language shifts. Risk is managed, not removed. For business professionals watching from the outside, this creates strategic uncertainty. Market signals may no longer reflect genuine supply and demand. They may reflect power, speed, and tolerance for delayed consequences. Competing in such an environment requires awareness, not trust. The purpose of this analysis is not to predict future violations. It is to highlight structural conditions that allow them. These conditions exist wherever complexity outpaces oversight and where consequences are absorbed collectively rather than individually. In the final part, the focus will shift forward, away from the past event and toward the broader implications. Because the most important question is not what happened years ago. It is how similar structures shape today's markets and what disciplined decision makers must do to protect themselves within them. For decision makers, the lesson is practical. Trust must be selective. Due diligence must go beyond surface indicators. Risk models must include structural uncertainty, not just historical data. Markets reward preparation, not optimism. There's also a broader implication. When confidence erodes quietly, participation changes slowly. Long-term investors become cautious. Innovation shifts elsewhere. Capital seeks environments where rules are clearer and consequences are consistent. Over time, this shapes economic growth. The responsibility for change does not fall on individuals alone. It rests with regulators, institutions, and policymakers. But individuals cannot wait for reform. They must operate within reality as it exists, not as it is described. This series does not conclude with certainty. It ends with caution. The system continues to function. Prices continue to move. Opportunities still exist. But beneath the surface, incentives remain misaligned. Until those incentives change, similar risks will persist, even if the names and methods differ. For those building businesses, managing capital, or planning long-term strategy, this understanding is not optional. It is part of the cost of operating in modern markets. Awareness does not eliminate risk, but ignorance guarantees exposure. By the time the case faded from headlines, markets had already moved on. Prices adjusted, volumes recovered, confidence, at least on the surface, returned. This is how modern systems survive stress. They absorb shocks quickly and continue operating. But resilience should not be confused with correction. The deeper risk did not disappear. It remained embedded in structure. The core issue was never one institution or one strategy. It was the environment that allowed a technical advantage to operate for years without interruption. That environment still exists. Markets remain fast. Oversight remains slow. Complexity continues to grow. For business leaders and entrepreneurs, this creates a silent exposure. Decisions are made based on price signals that may not fully reflect reality. Supply and demand appear clear, but they can be distorted by actors who influence perception rather than fundamentals. This matters because price is information. When information is unreliable, strategy suffers. Large institutions operate with layers of insulation. They have legal teams, regulatory access, and capital buffers. Smaller participants do not. They rely on transparency. When transparency weakens, their risk increases even if their behavior remains disciplined. One of the most important details often overlooked is market concentration. In many financial markets, activity flows through a small number of dominant players. Custody, clearing, and liquidity are centralized. This creates efficiency, but it also creates dependency. When the same institutions influence price, hold assets, and manage settlement, conflicts become harder to detect. Oversight requires not only rules, but independence. Without separation, accountability blurs. This is not a claim of ongoing wrongdoing, it is a structural observation. Consider how enforcement works. Regulators respond after patterns are identified. Patterns require time. Time allows profit. Profit reshapes incentives. By the time action occurs, behavior has already been rewarded. For young entrepreneurs studying markets, this creates a dangerous illusion. It appears that outcomes are driven purely by intelligence and effort. In reality, access and positioning matter just as much. Those who misunderstand this may take risks they do not fully control. The solution is not withdrawal, it is awareness. Strategic operators must assume that markets can be influenced by forces beyond public data. They must plan for volatility that does not come with warning. They must diversify not only assets, but assumptions. This is especially relevant in markets tied to leverage and derivatives. These instruments amplify both gains and distortions. Small signals can trigger large reactions. When signals are manipulated, the impact spreads quickly. The case examined in this series serves as a reference point. It shows how systems behave under pressure and how they resolve conflict without transformation. It demonstrates that survival of an institution does not equal repair of a system.